Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. December unemployment figures and earnings season taking center stage here as we open up another roundtable discussion with our editor-at-large, Steve Reitmeister, our director of research, Shiraz Mian, and that top market chartist, Kevin Matris. See, I gave you a new title, chartist.
I like it.
That's instead of technician. It's
Nice.
the same old thing. Sometimes you have to just kind of
shake it up.
Yeah, a little bit. But on Friday of last week, we're coming to you here, recording this on the 11th of January. Headline number came out for December unemployment, and on the surface, it looked pretty good, remaining at 10%, unchanged. But on this one, I think the devil was in the details. One in particular, the unexpected cut of 85,000 jobs in the month of December. Maybe cooling optimism a little bit. I just want to go right down the line and get your initial reactions to the report. What do you think, Steve?
Yeah, 85,000 jobs were lost versus plus 10,000 was expected. But here again, that was going to be the first month of positive job gains that people were hoping for. But really, it was within the general range of expectations. In other words, it wasn't that much of an outlier. And also with the jobs data, that there's so many revisions after the fact that the market kind of took it in stride. But just remember, last week it wasn't just that one jobs report. You had the ADP and Challenger on Wednesday, you had the jobless claims on Thursday. So it's such a week devoted to jobs data. And so people were ready for that report, and the market was up 2.7%. So I'd say in general, people were fairly comfortable with where the numbers were at.
Yeah, in fact, the ADP report was viewed as overall pretty optimistic. Shiraz, what do you think of Friday's report, though? 85,000 jobs. Jobs sector is not going to be recovering for a while.
Yeah, I wrote about this that day as well, and my contention was not particularly different from the way Steve put it. The headline number was bad, it was disappointing, but once you go into the details of it, the overall trend that we have been seeing in these monthly reports over the preceding months, that trend essentially remains the same. So we are seeing improvements, we are seeing stabilization, and we may not necessarily be way off from the time when we would see positive jobs numbers, maybe not in December, but definitely by the end of the first quarter, we should see positive jobs numbers. So the overall improving trend in the labor market and the positive sentiment about the underlying economy, I think that thing still remains the same.
All right, well, if there's anybody that can find optimism on this panel, in this report, it's Kevin, because he's the eternal optimist of the group.
Right. I don't think the unemployment report was that bad. Yeah, we did go in the wrong direction. We lost 85,000 jobs as opposed to gaining 10,000, but the unemployment rate remained the same at 10%. It did not increase, which is what everybody was forecasting. But the silver lining, in my opinion, that nobody is talking about is that we finally got our first positive print of jobs creation, and that came in November. The only unfortunateness about this is that it was revised into November's numbers, so nobody really got a chance to celebrate it. But if that report had come out and showed positive job growth in November, people would have been jumping for joy, and I think it would have been treated much differently. The other thing, too, when you look at the details about Friday's report, is that the biggest miss came from less government jobs created than had been expected. However, though, I think that you're going to see a lot of job creation from the government with the census numbers coming up in the next month. So I would not be surprised to see more jobs created from the government component in the next report that we see. But I think the takeaway is that there has been a steady rate of improvement when you look at the deceleration and the magnitude of jobs lost.
Yeah, they're really making a big push with that census effort as well. So if all of this is true, the market would seem to bear this out then too, because market really didn't budge much in the wake of the news. So nothing really here to, do you think, derail optimism as far as investors are concerned?
Well, I mean, the market did go up slightly on Friday, but here again, it was a week that was up 2.7%. I'll take that every week of the year if possible. So we have to put it in the context of the market was rallying into that news and held that news, and so now it's kind of like we're making way for the next round of news, which would be earnings and things of that nature. But I'd say that the market said, all right. The rate of job loss is decelerating. We're going to be getting to job gains soon enough. That's pretty good. Let's hold the gains that we've made, and let's see what else is coming up on the earnings and economic front.
And coming up on the earnings front is, of course, fourth quarter reporting season, Shiraz, that begins after the market closes today with Alcoa and a handful of other companies reporting. Is this what the market driver is going to be here for the next few weeks, corporate earnings?
Absolutely. We need to see growth in earnings. We need to see the outperformances and the better than expected numbers that we've been seeing over the last few quarterly numbers. One positive thing for the Q4 numbers is the relatively easier comparison to the really bad numbers towards the end of 2008. So the year-over-year comparison will look exceedingly better than we have seen in the last few quarters. But we want to see some top-line improvement. Most of the earnings growth to date in the last few quarters have been better cost management, particularly the payroll retrenchment, as we've been discussing earlier. So as long as we see some top-line improvement, the year-over-year comparison would be better. It should help the stock market in the coming weeks and days.
Well, the market, the street, pretty much looking for in the weeks ahead earnings for corporations to show, at least among the companies that make up the S&P 500, profit increases for the first time since the second quarter of 2007. So this alone is a positive thing that we're going to see surface in this reporting season. But it leads me to the next question. Has the market already priced in this earnings season?
Yeah, we've talked about this in previous weeks, that the market rallied considerably in 2009 because of what was expected when the economic cycle, when the positive growth and economic cycle took place, and what earnings would be like next year, or meaning this year. Okay, So the earnings growth projection for this year is 30% year over year, which is not unreasonable coming out of recession, but it is a lot. Okay, if we can make those numbers, then the current market levels make sense. If we fall short, in other words, if profits grow 25%, which is still nice, but it's lower than what was expected, that's not good for the market, which had rallied up and said, yes, show me the 30% profitability. If you can get it to 35% profitability, we'll go up again.
Kevin, what do you think? Market priced in earnings?
I think the market is expecting some good earnings numbers, but I'm already looking forward. And I think we are going to have another good earnings season. I think this quarter's numbers, everybody is expecting some good things. But I think the interesting thing to look at is that there is a nice, clear trend of improvement. And since all last year, companies have done everything they can to reduce costs to be able to increase their profitability. Since the projection is for a clear increase in revenue and sales growth.
Yeah.
You combine that increase in sales growth with the better margins, I think that you're setting up a situation where it could be very, very positive.
Yeah, that is another thing that we are expected to see, the return of sales growth in the fourth quarter. Now, is that just largely due to the holiday shopping season? Are we going to see that evaporate here in Q1? I don't know. It remains to be seen.
Well, I mean, if we do see all of this stimulus and it's supposed to really impact the manufacturing sector, I think there's going to be a lot of new opportunities, a lot of new projects out there. So again, you are looking at this increase in sales with the companies that have already gotten their books in order. So I don't think we're talking about just one quarter. I think you're talking about 4 months, 5 months, 4 quarters, 5 quarters, 6 quarters into the future.
What about volatility in the market for the whole year? A lot of people are out there saying this market's going to be volatile. It's going to be up and down.
It probably will be volatile, but you can see that that people are willing to assume risk. You can see this in the State Street Investor Confidence Report, which shows portfolio managers taking on more risk, i.e. buying more stocks. And you can see this happening with other investors as well. So there does seem to be, not crazy appetite for risk, but there does seem to be a greater appetite to take on equities risk.
You guys agree with that?
I don't. My assessment is that this is a more stable economic outlook that we are getting into in 2010. We have seen volatility that we haven't seen in decades over the last 2-3 years. We are definitely coming down from those levels. So 2010 is a year when we are stabilizing the outlook for the economy, for the market. So volatility is a perennial feature of the market as such, but definitely less than we have seen in 2009, 2008.
Yeah, right, exactly. The volatility, going back, because actually the last few months has been fairly steady, and even though the market hasn't gone up that much in the last couple of months, but there hasn't been too many scary periods, and the market's just been in a nice, slow, steady upward progression. But some of the volatility from early in the year, where you're gaining 3%, losing 3%. Very few people have the stomach for that kind of action. And so, yeah, I think, right, it's about stabilizing economy, stabilizing rates of return in the market, getting back to something like old normal.
Okay.
Something like old normal.
That's right.
Whatever that happens to be these days. We're going to leave it right there for time, but we encourage you to keep tuned to Zacks.com for updates in commentary, particularly as it pertains to this fourth quarter earnings season. And with everybody here at the roundtable, I'm Terry Ruffalo.